Hi everyone, welcome to the channel and thanks for joining us. My name is Jardine and today we are going to talk about tax loss selling and how you can potentially save in your tax bill in the spring. Look, I get it, it's nearly Christmas and you're probably sitting there thinking that your tax bill in the spring is the last thing in your mind right now. I will be the first to admit that Christmas parties, drinks and good food are much more appealing, but hear me out for a few minutes. It could end up the difference between a really good summer vacation or a decidedly average one. At the time of recording, to put it very politely, it has not exactly been a great year for growth in portfolios. But maybe you sold off some longer term holdings earlier in the year and are sitting on some large realised capital gains as a result. This is where tax loss selling comes into play. Let's get stuck into what that means and how it can benefit you. Typically, the strategy begins with selling an asset or stock that you hold that has fallen in value from when you originally bought it. Given the year that we've had in the markets, I am fairly certain most of you could take a quick peek at your statement and identify a couple of holdings in this position. Once you identify the positions in question, you hit the sell button and incur a capital loss. This loss can then be used to offset any capital gains that you may have incurred earlier in the year. That is the short and simple explanation of what tax loss selling is, but there's a bit more than that you need to know. 1. It can only be done in a non-registered or corporate investment account because these are your taxable accounts. You know all those T-slips that you have to report each year when you file your taxes? Yes, those accounts and those accounts only. You should absolutely never be talking about tax loss selling in a RRSP, TFSA, RIF, LIRA, LIF or any other registered account. So just so we're clear on that. So then, how exactly is a capital gain realised then? Just to get into some basics here. You know, if you buy a position for $10 and then you sell it at a later date for $20, you've realised a capital gain of $10. Depending on your tax rate, you could pay up to 25% in taxes on this capital gain. Paying any more in tax than you have to is never ideal. So how exactly can you avoid it? Well, as mentioned earlier, if you have positions in your portfolio that you have bought and that have fallen in value below their original purchase price, you can look at tax loss selling. An example would be if you bought a stock for $10 and it's now priced at $5. You would sell the position that has fallen in value and replace it with a similar position or perhaps an ETF because you still want to have some exposure to that stock. Let's say you still believe in the prospects of the stock that has fallen in value and still want to hold it for the long term. The CRA rules state that you cannot repurchase that position within 30 days. Why? Well, really to prevent you from selling one day to lock in the loss and then repurchasing the exact same position the following day. Now, the CRA does not like this, so do not try and get away with it. What you need to do is sell the stock and exit for at least 30 days. This is very important. In the meantime, assuming you still like the position or the sector, purchase a similar stock or ETF to try and limit the hit if your original position decides to take off during the 30-day time period. Then, after the 30-day time period is over, you can flip the trade and buy back your original position. Of course, if you want to exit that particular stock or sector completely, then there's no need to purchase anything similar. Hopefully now you've got a better understanding of how you may be able to apply tax loss selling as a strategy to reduce your tax bill. If you are already a client of ours watching this, then you do not need to worry. You have this done for you automatically each year where it is applicable and where it makes sense to do so. So, just to round off and summarise, you can reduce your tax bill on any realised capital gains by 1. Selling a stock in a losing position, 2. Replacing it with a similar stock or ETF if you still want exposure, and 3. Wait until the 30-day time period is over so that the loss is deemed valid by the CRA, and 4. If you wish to do so, that point, flip the trade and repurchase the original position. That's it for today's video. If you have any questions on tax loss selling as a strategy, please do reach out in the comment section below. I have one request before you get back to your holiday indulging. If you have enjoyed today's video, give us a thumbs up and subscribe to the channel. I'll see you next time.